Hey everybody, morning. My magnificent monsters, grab your caffeine of choice. Gotta be wide awake tracking these massive financial tremors in the market because, well, most of the market is distracted by all these headlines out of Iran, the dominoes that I started warning about last summer and especially in October. They're lining up and falling right into place and starting to tip over right here at home. And the first place to get crushed by all this, widows and orphans. It's kind of a sad reality here. Insurance companies are holding 35% of their portfolio in all this private credit slop that I'm talking about right here. If you have a pension plan, annuity, life insurance policy with the big fellas, I mean, we're talking about MetLife, Prudential, AIG. Probably should listen up a little bit right here. This is the why this matters to your wallet moment right here. The $1.8 trillion private credit bubble, it's coming apart. The more we try to plaster over it, the more this thing is coming apart. Steve Eisman, yeah, this is the guy who called the 2008 housing crash from the Big Short and all that, like, if you don't know him, he's very famous for calling it, right? He's gone on the record calling this a slow brewing scandal that could spark another financial crisis of epic proportions. Why? Because these private equity firms have been using our insurance premiums to buy their own garbage loans. It's just like what happened 20 years ago. I mean, this market, except the big thing is they figured out how to use our money to do it. I've been talking about this. These loans are defaulting because AI is vaporizing the business model that all of it was set up to. I mean, it's just, I've talked about this. This software as a service is just getting decimated because it doesn't take an army of engineers and time and effort to build these things. You can just tell an AI in a couple hours you've got a tool. And it could be more customized to your business than what a traditional software company may have spent years developing. And your safety net is currently catching on fire as falling knives poke holes through it. Now, I'm going to show you what's exposed right here, who's holding the bag, and how you can potentially profit from it. But first, let's rewind the tape. How did the most boring, the most conservative money on earth, life insurance companies, become ground zero for this shadow banking crisis? Here's what's happened. Here's how it unfolded. So after 2008, the regulators cracked down on traditional banks. They said, we're not going to let you do any more risky lending. So this segment of the market, it just doesn't go away. It doesn't just, it just didn't stop. I mean, it had to find a new place. It put on a fake mustache, some glasses, and moved over to the private equity markets. Private credit exploded into a near $3 trillion behemoth. Now, insurance companies got sucked into this, and they have a problem. They take in your monthly premiums, and they need to invest that money to generate a return so that they can pay you what they owe you when you die or retire or whatever, depending on which kind of insurance you get. But in a world where bonds were trash, I mean, bonds haven't been performing, right? They're not good enough. These insurance companies, you got to make the numbers look good. They got to get their bonuses. They got a little greedy in this whole thing. They started chasing yield. It's the same old trap that many of us fall into. If I just go after a little bit more. I mean, even on the beer money trade, I see some of my traders I trade with going after just a little bit more. I just want a little bit more. 1% a day is not good enough. get stuck in this greedy trap. They started buying up private credit loans. Well, who sold them those loans? Well, you got private equity giants. Firms like Apollo, Blackstone, KKR, the ones we hear. In fact, these PE firms got so smart, they just went ahead and bought the insurance companies outright. Apollo bought Athena. KKR bought Global Atlantic. They took the insurance float, which is your premium dollars, and then used it to buy their own private credit paper. And oh man, this gets even better though. Just bear with me. To hide the risk in this whole thing and make it look legit, they have offloaded billions in liabilities to offshore reinsurance shell companies in Bermuda and the Cayman Islands. I mean, this sounds like a movie, right? It probably will be when this all comes apart. Places that don't have to file U.S. financial statements. Forensic accountant Tom Gober looked at one of these setups and found $7 billion in liabilities backed by roughly $200 million in actual real assets. Think about that for a minute. $7 billion backed by $200 million. I mean, that leverage is insane. The rest was backed by what he can call what Tom called contingent instruments, which is Wall Street speak for lottery tickets. This is getting pretty bad, everybody. The cherry on top of all this, the rating agencies, if you think back, if you were trading, if you were in, anywhere in this space, if you knew anything about 2007, well, rating agencies are the ones who rubber stamped a blessing on subprime mortgages, CDOs and AAAs. Well, guess what? These rating agencies are doing it again. Bloomberg reported that over 3,000 private credit instruments are rated by a tiny firm called Egan-Jones, who, get this, their massive office building where they employ, all their investigators and reporters is a 4-bedroom colonial house in Pennsylvania. That's it. That's their single location. A firm that, by the way, has already been probed by the SEC for a conflict of interest. Egan-Jones, this is. These are the guys that are slapping investment-grade stickers and high, awesome ratings on these private credit loans, allowing insurers to hide the true risk to their clients. So how is this even possible? What went wrong? Why is this going to blow up right now? And it all harkens back to the AI stuff. The artificial intelligence has entered the room. You see, a massive chunk of these private credit loans, roughly 40% of all private equity-backed loans, were given to software as a service companies. Back to the SaaS, software as a service, SaaS. These are supposed to be safe, reoccurring revenue type businesses, but all of a sudden, AI agents arrived to the party. All of a sudden, nobody needs a dashboard. Nobody needs bloated software suite. AI agents can just do the thing you need them to do. The revenue for these legacy SaaS companies is starting to collapse. Whenever revenue collapses, you can't pay back you can't pay back that massive private credit loan that you took out. UBS has put out a terrifying note forecasting that a rapid AI disruption scenario is going to be playing out. The default rate for private credit could skyrocket to 15% or higher. For context, the historical default rate for these software as a service company loans is less than 4.5%. So this is a massive 3x, 300% increase in defaults. I mean, think about how profound the irony is right here. The AI that's supposed to be the future, the great productivity engine that's, all hyped and all the GPUs and all the awesome stuff, but it's also turning into a wrecking ball that's destroying stable cash flow in the tech loans, turning those into zeros overnight. And who's holding the bag? Us. We are. Our insurance companies, our pensions, our widows, our orphans. You can't make this stuff up. We're no longer in a warning phase here. This is starting to be the panic phase. So let's look at some of the framework here. I mean, this widow and orphan trap 2.0 timeline. Last October, the IMF warned everybody. They explicitly said insurers, which we're talking about life insurance and not like health insurance and not car insurance. We're talking about like life insurance and annuities and, these insurers. They're holding 35% of their portfolios in private credit. And that's misclassifying these loans. And that could lead to catastrophic losses. The market, we kind of shrugged at the time. I've been talking about this for months now. The cracks were appearing. Now we've got more. In February, we saw Blue Owl, a major private credit player, froze quarterly redemptions on a retail fund, and they had to start liquidating $1.4 billion in assets. Their ticker symbol, OWL, Oscar Whiskey Lima, is down over 30% this year so far. And we're only in the third month. That's like 10% a month. Then early March, we're still early March. It's only the ninth day, right? Things have been escalating. Blackstone is facing a stampede for the exits on $82 billion in its BC RED fund. That's Bravo, Charlie, Romeo, Echo, Delta. Redemptions hit nearly 8% in this fund right there. To avoid gating the fund and causing a total panic, Blackstone literally had to pass the hat around the office, tapping executives to inject $400 million of their own capital to keep this thing going. That is kind of a desperation move. You don't do that if everything's fine. I need to get I got a little Lego thing. It's got the dog with the flames. And everything's fine. Everything's fine. And then the big one. We're only 9 days into the month, right? BlackRock, the $14 trillion gorilla out here managing so much money, gated its $26 billion HPS private credit fund. They capped withdrawals after getting hit with a $1.2 billion redemption request or exit request. On top of that, another BlackRock fund just marked the loan down from 100 cents on the dollar. Think about this. Get this marked down right here. We marked it down from 100 cents on the dollar, which is a full dollar per dollar, to 0 cents per dollar. This isn't a bug. This is apparently a feature. When you build a shadow banking system with no transparency, no regulation, no oversight, and a complicit rating agency that runs out of a suburban house in Pennsylvania, you don't get stability. You get chaos, just waiting to unfold. And because private equity funds and private credit funds have gates, they can just stop redemptions. Investors are trapped inside the burning building. You can't get your money back. You got to wait and see how much of their money is actually going to be there when the flames died down and the dust settles. So, enough of the doom and gloom, right? Where there's chaos, there's always opportunity. Let's talk about how. We've talked about how we can make some money out of this before, but let's look at the direct losers here. Blackstone, their ticker BX, Bravo X-Ray, their stock has dropped almost 7% on the news that their employees are having to inject capital to keep everything float, keep everything working. Private credit is the core to their business model. So maybe some puts on Blackstone if you wanted to get aggressive with it. We want our weekly or bi-weekly puts. If you're going to go after those, that's where you would want to play. You want to manage that theta decay. Now, the narrative is building if defaults materialize. I mean, you could always go out with a leap, too. Then you would have something to sell some other instruments against. Blackstone has another 10 to 20% downside if UBS predictions come out. But remember, this is kind of a directional bet. If the Fed steps in with some sort of bailout, we're gonna fix this thing for you. It's too big to fail. Things could reverse quickly. So size your positions accordingly. Now, what about the insurers? This is where things get a little more spicy. Companies like MetLife, Mike Echo Tango, Prudential, Papa Romeo Uniform, and AIG, AIG, are heavily exposed. If you want to get longer term short plays, look at put spreads on some of these most exposed insurers. The market has not fully priced in capital erosion. And when that happens for these investment grade loans and suddenly they get repriced to zero, what do you think happens? But, what if you want to play defense? What if you want to play a different way? If you look at our morning scanner here, we've got some safe haven dividend plays. Utilities, XLU, consumer staples, XLP, high dividends, low betas. But when the credit market seizes up, capital flees to safety. And honestly, don't sleep on stuff like gold or GLD or IAU or even the Sprott funds. It's already catching, they've been catching a bid. They may retrace a little further as we see these geopolitical distractions in the Middle East masking the real rot in the credit markets. So let's be brutally honest here for a second. This risk isn't just that a few private equity funds are blowing up and a few rich guys lose some money. This risk is contagion. The risk is that insurers misclassified below investment grade trash as investment grade, poured money into it, and now the capital buffers are eroding, if not disappearing. Goldman Sachs just put out a warning that the rapid shift to private credit creates a massive liquidity overhang. You have these funds making 5-year illiquid loans, but offering quarterly redemptions to investors. That's like a structural mismatch that ends in tears and maybe wishing you could buy beers. And in fact, spreads on life insurers and their debt just spiked to the highest level since May. That's May last year. The market is waking up to the fact that these insurers are actually holding some toxic bags of chaos. In a world of chaos, the only thing that you can truly count on, though, is relentless, beautiful, and terrifying illogic of the market. And the market is now pricing in what happens if you build a house of cards on top of a volcano. And if you want to survive this trap, well, you need to stay nimble. You need to stay quick. Cynical is probably the best way. And stay away from that private credit slop the best you can. So, yeah. Let's look at some other charts. Try to figure out what's moving today. Be careful out there. I told you I'd stay ahead of the potential, what causes the crash scenario. For a long time, Goose is in the background talking to me like, hey, what do you think is going to cause everything to come apart at the seams? And this seems to be where the problems are forming. It's something to watch out for. All trading involves a substantial risk of loss, so past performance is not necessarily indicative of future results, and this presentation is intended to be informational, educational, fun, entertaining, not a recommendation to be buying or selling any financial instrument, including stocks, options, bonds, forex, futures, cryptos, treasuries. If you trade any of those things, you're probably going to lose money, especially if you do it naively. 90% of traders lose money, so be careful out there. If you want somebody to tell you what to do, there's people you can hire, but your mileage may vary. YMMV. Hit a milestone. Well, about to hit a milestone, I guess you might say. Refresh, reload. Look at this, baby. All time, 79,000 right there. Year to date, 27.7, and the 1 year is about to crack $80,000 on the 50K challenge. There's the equity curve. Now, the 50K challenge, just in case you're new, you haven't seen this before, the goal here is to create an income stream from trading that generates 50K a month. Now, what funds a challenge if you just hit it right away? So a year ago, almost a year ago now, getting to be 11 months ago, back in April 2025, I started this. I had to borrow some money. I funded accounts with about $75,000 and got started to build this account into a machine that generates $50,000 a month. You can ask why. There's lots of, why, how, blah, 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 blah. But the whole point is I was going to produce reliable income of 50K a month. And I'm going to, I'm sitting here documenting it every day, how I'm building this into a machine that generates 50K a month. Now, 14.6K, it's not 50K. Still got time to go. When I started this, I thought it might take me 5 years. And a lot of effort, a lot of trades. Right now, it might take me, with the path I'm on, with the compounding I've been able to implement, with the luck of the market, it's quite possible I get it in 2 years or less. We're coming up on year 1. This has already been a year. Almost doubling the money. You say, well, you borrowed that money too, so you need to pay it back at some point, right? True. True, totally true. But if I can keep pushing the way I'm pushing right now, potentially I could be there by March next year. Maybe April. By the year 2 mark. We as humans tend to underestimate what we can get done in 5 years, tend to overestimate what we can do in 1 year. 1 year, I didn't, I'm certainly not at the 50K goal, even 1 month out. Probably not going to be there. And if you're wondering, how do I see all these trades? kinfo.com, right there. I have them all posted. Everything I close is posted publicly. If you want to see the trades as I place them, it's my Turnmeyer Trading Lab group does. Links in the description. I share it all with them. Just thought I should say, if you're following a guru, make sure that they actually make money consistently. They're just throwing spaghetti at the wall. You may or may not come out. Oh, look at this. Down to the roadmap line as we thought would happen. NDX, are we making the lower low yet? Not yet. NASDAQ needs a lower low. Gotta get down here. This needs a lower low. Let's look at the futures and the overnight action. We had a gap down. Sold off. The actual low occurred in the, I guess in the evening hours last night. We're actually bringing it back up. Probably going to gap fill, would be my guess. And then, very classically, we gap fill and then run it on down. This is where big money got stuck, and they're like, mother fudge, I didn't plan on this. I need to, so the big trading desks will smartly use capital to push it back up, and then they let the rope go once they get the big position offloaded to people that think we're going higher. Happens a lot. Same kind of path, same kind of picture on NQ. We made that low right there last night, bringing it back up. And all of this kind of stems from that chaos in the Middle East. We saw oil cracking, like, I think that was 118 last night. It's the alert I got. 119, yeah. 119.48 was the peak. Already bleeding it back down. This one may be coming back into the gap. Still right there around 92. And don't be surprised if that was it. That was the peak. I had warned about this a long time, that we would come back up and retest this 618 level. You gotta be careful. There's a big spike when we went negative in 2000 that wants to jump on the screen here. I warned about this though, that we had made this high back here in 2022, sold off hard as the A wave in 2023. Quick, fast retrace, B wave. Came down, lowest low, right there, late 25. And here we go, ramping right up to the 618 test. That level, right up in there. Actually poked through just a little bit, but we didn't get up higher high yet. So this could all be, this is what you got to watch out for. This could all be an A wave, a big 3-wave A wave, or possibly even a W wave. This could be an X wave. It's kind of really fast, no pullbacks, just one big rip. And then we could go all the way back down. It'd be absolute crazy from right now, but that kind of stuff is in the chart. And if you look at it on the daily chart, that is one big buyers are losing control type of candle right there so far. If we ended the day right now, that's a nasty candle for a sharp reversal. Just price action. You can say whatever you want to. You don't believe it. You don't whatever. But that's... We tagged the 618 reversal zone. And now, if we can't stick it, watch out below. Now, we are way far away from the daily roadmap line too. Daily roadmap line still sitting down here in the 60s. We're up here 30 points higher. That invites a big retrace. And this is the #1 component of inflation. If this hangs out up here, inflation being high, that pushes the rates higher. We're already seeing this right here. The 2-year constant maturity rate, the blue number right here, already spiking up. If we cross the Fed funds rate, this is going to be, and it keeps going. If this crosses the Fed funds rate and keeps going, we're going to raise rates. Trump is going to freak out. We're going to slow the economy down even more. Sitting here, the charts are telling us. Funny enough, I predicted that we would probably go sideways for a while, little iterations in there, and then probably raise rates some more. Didn't have my timeline quite right, but seems to be kind of what's happening. We held in here, and now we have potential to raise rates again. So be careful out there. And then that could spark off the real financial crisis, where all this credit stuff pops. Then we can see rate cuts and emergency rate cuts and all that sort of thing as they try to control the chaos. It's going to be a wild one. So gold, still set for this drop. This is cooking at 1, 2. Next move will be 3, 4, 5. The potential to find a bottom somewhere down here in the 38 to 44 area. I just don't know if it gets like, if we come up just a little shy here and just tag the roadmap line with a lower low, or if the panic sets in and we really flush this on down to the bottom end of the range. Keep an eye on this right here. The next move, we just go off of what we've already got, potentially down to 45, 80 area. Pop down there and then push on down. Maybe find something around 42 as the bottom. We'll see. Ideally, we would be down around 4,000 on the correction on gold. Bitcoin, just chopping in here. Just keeps chopping. We spiked up in there. We retraced. And was that enough to be... So we did a 618 retrace. Like that's A, B, C. And then came up shy of the A equals C. Retraced. Almost tagged that 618. Now we're coming back up. This can go right up in here. 78 to 86 area. Roadmap line on the daily. That could be the next move. And then we embark on the bigger B wave here. So this could have been an A, this could be the B, and this could be, or WXY maybe. And then we do the B wave retrace, and then the C wave climb into the 618 of the big drop from the October high down to this February low. So very similar to oil, just, you know, smaller time frame. Ethereum still sucking it up too. Dollar is still sitting on top of the roadmap line. Still cooking here. That's a lot of price rejection though. Look at those candles up there. Look, all those wicks. That's buyers losing control. We may see this reverse sharply. Of course, it could be just simmering here and we pop through. If we can get above 102, this thing's going to grab some legs and take off on up toward 120, 130, 140. That's really going to put the screws to the narrative. NKD almost made it back down to the roadmap line as briefed. Probably got more to go. As this goes, so goes global liquidity. And as I mentioned, as this drops, we're going to see down pressure on S&P, down pressure on NASDAQ. And that's exactly what's kind of playing out here. Now, this can develop into a bigger drop. So this is one to be careful and cognizant of here. Got this initial drop going so far. If we rally back up from here, watch out around this 57,000 area, 56.5, 57, maybe 58. If we turn down from that, this can develop into a bigger downside risk for the market as global liquidity sucks out of the market. And we can see this thing dropping very swiftly from there down to 44. That's going to be a huge liquidity hit, which means a steep pullback. And this could all unfold. The timeline on all this, that's what everybody was like, you know, when do you expect all this to happen? The timeline on all this is probably going to unfold by next week. The real chaos in the market typically wraps up by VIX OPEX, which is right here at 1718. Last day to trade VIX is the 17th. And then the options expire on the 18th. And that's not the normal, like everybody's used to the third Friday of the month. That's not the way VIX works. And that's why we usually see this mid-March chaos, and it's in the seasonality. So it's one of those, when we're coming into March, you always got to be kind of careful and cognizant that there's a historical chaos that happens in March. If I pull up the volatility right here, pop it up, pop it out. This is a 20-year average of VIX seasonality volatility. That right there is the VIX OPEX right there in March. It's usually the biggest one of the year. 20-year average. It's got everything in it. Basically, it's got the dot-com bubble. It's got the great financial crisis. It's got pretty much everything cooked in here. This March VIX OPEX, it's where we peak. And then the market tends to rally. So you can basically, you know, late next week, maybe after next Friday, go long and ride it through Memorial Day. Then we get a little chaos in the summer, sell in May, go away. That's it. That's why. Like, we rally from the VIX OPEX through in March through Memorial Day. Then the markets get kind of boring. Then we pick back up in October, and then we rally into December, and we start it all over again. It's just the way the trades work. The news cycle, of course, everybody's like, oh, it's the news cycle. It's this, there's a blah, 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 blah. It's just the price cycle right there. So be careful. This could go fast. But there's always the chance, there's the most probable things. And then there's what's possible. What's possible is anything. Anything could happen. We could extend this thing right on through. But the most probable thing is that this chaos wraps up sometime next week. And we got 2 weeks left. And then rally on, Wayne. Rally on, Garth. So we got Apple coming down into the roadmap line. Want to see this hold. Get back going higher. Break through this small downtrend of highs we've got cooking right now. 295 would be the upside targets. Amazon. Still working on proving that this is the bottom in place. We need to get through the roadmap line. We kind of came up trying to fill that gap. Rejecting off of it. Next attempt up. Probably fill that gap. Reject back off of it. And set up to go higher. Google still hunting for the daily roadmap line. Still got a little more downside to go. 270 maybe. Meta. If we can hold on to this uptrend lows over here, that's bullish still. We've set up the reversal. We tested the 618 retrace back here around Thanksgiving time in the US. And we've made a higher low. We made a higher low. If we can hold these intact, still bullish. 1100 to 1300 will be the target. Might take a couple years to get there. Microsoft trying to prove that this is the bottom. It's a whole lot of green candles. A whole lot of buying in here. This gap down and the roadmap line right in the middle of it is going to be the resistance going higher. We need to go up there, test it, probably get a retrace, and push on through. NVIDIA, be careful. The risk here is that we bust on down below these lows and take a trip down to retest the breakout, not from this past December, but 2 Decembers back. 2024, we made a high in NVIDIA right back here. And we haven't been back to test it. We just busted right on through in July last year. Retrace, bust right on through. We're probably going to come back and test it. Probably going to do it. That's down around 150. And if we don't hold on to that, could take us on down to 120. Tesla reaching down for that 370 test. I mentioned quite a bit last week that we would probably, this price action was telling me we were probably going to go down and test 370. It's probably what we're going to do. See if we can find support down there. Netflix, find a resistance at the roadmap line. This is one to watch. If we turn down, we need to hold the 618, which is roughly the gap fill right here. To take a few lines off of here. So right now we have this low, we have this high. Yep, look at that. That's 618 right down there at the gap fill. If we can hold that, break on up through, that's bullish. And then the next resistance is right up there at that 618, right around 107, 108. Now, if we break below this, probably coming on down to the 60 to 70 zone. We got close at 75, but probably push it on down in between the 60 and 70s to look for a bottom. So this is a key important resistance right here. Got to watch for the retrace. If we can hold anything above here and bounce, that's positive. Then we got to get through this 108. Otherwise, if we break on down, probably getting extensions down in the 60-70 zone on Netflix. So I go pull gainers. These are things moving up $2 or more in the pre-market. I go pull decliners, things moving down $2 or more in the pre-market, and hunt for opportunities. You know, today we are looking at XNE, XENE. That thing gave you almost no warning, although right there was the entry. Right there. And then boom goes the dynamite right way up past all the targets. I don't usually play biotech pharma. That's just a dangerous place to play. DNTH, another therapeutics. Usually when biotech kicks off the list, it's going to be a chaotic day. That's what we've seen in the past. USO, boom, shakalaka. That monster. Let's see what UCO did. Almost to my 41 targets. And if you're a little more skeptical on this, if you're like, you know, I kind of feeling like we're going to retrace pretty deep. Look at this thing. Fell out of the bed. SCO, leveraged short on crude. If you got a healthy stomach for trying to catch the knife and going back the other way, SCO could be the way to play, or you could just play some puts on UCO because these are going to get demolished as we reverse. If we reverse, when we reverse. USO, it's the one-to-one way to play. United States Oil Fund. We haven't gotten out of the crap yet, though. This thing definitely making a higher high, though. Up to the 1618. This is probably getting to be the resistance here. So watch out. Full retrace back to the roadmap line, right down in here. Could be in order. Lumentum probably coming back to the roadmap line. Hadn't been there in a year, so due for retrace. HIM's getting big news. It's cutting a partnership to get back in the GLP-1 game. Got to get up through the roadmap line. Got to get some upward momentum going. LMT. We're at the extension. Possibly could extend 792. Watch out for that one. VRT. Probably needs to revisit the roadmap line. I don't know if that's a bottom or not. That looks pretty nasty right there. That hit target 1, 2, 3 so far. Retracing. I mean, that was a beautiful upside, but now we got to find some support here. We're down in the zone to find it, but got to get back above the roadmap line to go higher. MPC. And be careful on oil stuff. The oil can reverse on you so quick. It's kind of like gold. You know, we were hyped up on gold. Now all of a sudden, black gold is the hype. And I guess the real story, when you look at this reversal kicking off. I mean, like how deep could we go on the gold oil ratio? This is gold. This is oil priced in ounces of gold. Take dollars out of the equation. We had pushed this down to levels we hadn't seen since COVID. And now all of a sudden it's ripping. So you look at the long-term historical on this chart. Take dollar volatility out of the equation here. Or price on oil like it's like we're gonna quit using it. You know, the historical up here around 0.06 ounces of gold per barrel of oil. And we're probably gonna rip that right back up to it. Takes dollars out of the equation. So you think about, like, we have a hard time because we price everything in dollars, but this is oil priced in gold. And you can flip it around too. You can price price gold in oil. And with the big asymptote on the chart, kind of skews it. Long-term, kind of historical here is right around 20 barrels of oil for 1 ounce of gold. We had made a crazy high back here, but we're coming back down quickly. So that's one to keep an eye on. Like, we've got to bring balance back into the oil and gold market. If oil is as valuable as it would seem, it's not being priced that way right now. Even though it's like, holy cow, it's at 100. Holy cow, it's, but in relative terms, it's still extremely cheap if you're buying it with gold. And Sats is probably coming on back to the roadmap line. There's a lot of decliners out there today. KRU continuing the chaos. Even though it doesn't look like it. Probably coming on down. EWY. Probably bleeding on down. We're probably going to get down to the roadmap line. If we bring it on down to the roadmap line here on the Korea ETF, KRU is probably going to see that bigger swing lower. Could be down here around 100, around the breakout. Seeing things move around quite a bit. It's got some recovery going already in some sectors. Remember, this chaos can continue till next week. Big swings, volatility. Hunt around for a couple opportunities. Capital One's getting beat down. I was looking for this to do a bigger retrace. It played out a little higher than I thought it would. Now I'm actually interested in this if it comes back into this 95 zone. I might pick that up as a measured bounce to go higher again. Ultra Pro S&P needs to make a lower low. 1, 2, 3. Need to come down just a little bit lower on UPRO. Reddit still has lower to go. Owings Corning, we're back down to the roadmap line around 95. IBM coming up for the roadmap line test. Dell. We can stick that pop above the 618, 178, 187 up there. Marvell, no sign of anything. ANET, no sign of anything. Eris, no sign of bottom. Now that could take, this can do a bigger retrace here. That was potentially 5 up. Let's see. Pull this up to the top. So support back down around here. If you didn't catch anything on the upside here on UAL, waiting for it to come back down below 80, that'd be the spot to start selling puts if you wanted to catch the next move. It has a nice beta for selling puts. AMD. So if this thing can hold right here, hold this gap fill, we have a nice upside going potential. But if it lets go, we may come all the way down here to like 160. And if it can't hold that, 125 would be down here at the 618. There's potential this thing goes deeper. It doesn't have to hold here. Just looks good if it holds here and bounces. But so far, we're not bouncing. We're just grinding. Holding up really well, but one little oopsie can push it down quickly. CCJ, roadmap line, snow. That's a nice reversal we got cooking here. We back tested the downtrend of highs. It's been going for a while. This breaks back above the roadmap line. We could be looking at a massive upside here, even though this is a SaaS company and got thrown out with the bathwater. I think their technology is something different there. KKR getting punched in the face. I did bring in another list of stuff here. My OpenClaw bot wrote some cool stuff here. Said, this was based on the story. Look at notables for private equity exposure to the downside: BX, BLK, Ares, KKR, APO. Major banks with private credit desks: Goldman Sachs, Morgan Stanley, JP Morgan. C. Energy cluster, Iran war overlay, USO, UCO, XOP, EOG, FANG, LNG, STNG. Be careful on that LNG though. We're kind of already running at capacity. Defense, NOC, LMT, RTX, KRMN. And then if you want to check out some leverage inverse type stuff, SQQQ, SOXS, FAZ, SRTY, boil, cold. Volatility plays are active. So, and that was written by my OpenClaw bot. So, yeah, Ares. Get on the right screen here. Ares looks a lot like BX, BLK. Not quite as bad, but they still have downside exposure. APO. Yeah, and KKR, of course. So we're seeing a lot. Those old charts look a lot the same. Then we got Goldman Sachs getting hit a little bit. Morgan Stanley hit a little bit. JPM hit a little bit. Oh man, that's right in the target zone. And Citibank, Citigroup, not quite down as far as it could be. Interesting. Now, as we get into OPEX next week, might be an opportunity to pick up some SVXY for some upside. Now this one, when they did this split back here, they kind of messed it up. It was very reactive until they did that split, and then it muted it a lot. So this pullback is going to be pretty deep. The one from last year was really deep. So if we get more pullback here, this is short volatility. So if we see a big spike down, it'd be an opportunity to add some for the recovery here. Let's see, I had one set up for today. Musa, Murphy USA. It's already starting to be played out. There was the entry for, wow. Here's the entry. 476 is the target. So the risk reward's a little skewed here, so I'd be very cautious. So we're only looking at upside target here, the downside target down to 360. So you've got a upside of 27 versus a downside of 86. That's 4-1, roughly. I'd be careful. 3.5 to 1. So the bigger risk, the bigger the risk compared to reward, especially if it gets near 7 to 1, then that's an indication this may fail. That's 359 really. So that's a one today that's set up. But look at the history of that 90%, even though we've only got 11. So anything less than 30 right here is not a statistical population. So it doesn't mean anything. You can flip a coin 29 times and get heads, and it's really not a statistical population. But once you get 30 and you start hitting heads more often than not, past 30, there's something about that coin that gets more heads and tails. So something about this stock, if we can get up to 30 trades, but that's going to take a while probably for Murphy. So that's if you're not familiar, that's gas stations at Walmart. Kind of work on their own. I guess maybe it's a subsidiary of Walmart some way, somehow. I don't know. I've not dug into it. Don't really care enough. And let's go back and make some predictions on where we might end up today. What do you say? So Friday. Hung right in the middle of the zone. Today, look at the big gamma levels and see where we might end up. Yeah, I wasn't very confident in the levels on Friday. So let's see what we might do today. Come on, the gamma charts. Where did you go? We got too much stuff popped up. Seem to have popped something up over top of my gamma charts. Cool. Or maybe I just closed it. Here it is. I found it. So, gamma, where do we go from here? SPY. This is bullflow.io if you want to grab it. It's probably the cheapest place I found to get gamma exposure. And it's the coolest, like this heat map thing is the coolest way I've found to look at it. There's a big level sitting out here at the monthly OPEX. This is why I say we could see chaos from now through the monthly OPEX next Friday. Got a big level stacked in here. Now, just cruising through, looking at these, we got some big levels all the way down in here. Oof. That's down at 650. Yikes. They've got it stacked down in here. At 660, he's got almost a $500 million. Gamma exposure. And there's some downside risk here based on the options. I'm gonna have to make a pretty big downside range here. Potentially down to 650. Potentially up to 670 on SPY. So the top end of the range 670, bottom end of the range down to 650. We could get some more downside going here on SPY. And if we go check out the levels, you can look at them stacked in here. Yeah, be careful. The call players are getting thin. Put players are hot and heavy here. If I was just going to guess, I'd guess like a pin around 669. Big level sitting out there at 660. Biggest level. So 660. Kind of the biggest level. We may go visit that. Like I said, the kind of balance in the puts and calls. Actually, let's go with, yeah. Right around 669. It's kind of where the puts and calls balance. But so far we've had downward pressure and not rolling with it. So watch out for this to develop into something worse on SPY. QQQ. Fingers on the right keys. Jumping back over here, grabbing the QQQ. Check out the heat map first. We got a 590, still hanging in there for the end of the month. Not really any big levels here. I mean, we've got 100 million there. It's pretty thin on the Qs. Not what I like to see. I mean, still not a lot of players playing big tech. So it looks like we could come on down to this 585. 100 million there. Oh, 200 million there. 580. I'm going to have to expand the range looking at this monthly here. So looking down to 580 and probably up to 600. That's what it looks like as far as the range that we can play in today. And we're kind of hanging in the middle here so far. Let's see if we can figure out where the biggest levels are. And the exposure is really, you look at this as the 9th today. There's the options played are so small compared to this monthly OPEX out here. This is where all the players are playing out here next Friday, not this Friday. Look at that. $3.3 billion worth of put gamma and $1.5 billion worth of call gamma. Compared to today, right now, we just have about 1.2 billion in put gamma and 300 million. And we're building the puts, but it's still, dwarfed by the monthly OPEX. And this, this chart right here sums it all together. So we've got a real flip point sitting at 600, and that seems to be where the flip point in the chart really culminates here is at 600, but we're below that right now. So we could get that dip and rip back up here by the monthly OPEX. I think that big monthly OPEX is really skewing I have no way just to set this to one expiration. That's just not a thing that bull flow supports. You can see it on the chart here. Large gamma exposure down here, large gamma exposure here, right where we are, chopping in here. So, trying to read the tea leaves. I don't know. We got some chaos cooking. Looks like probably still not through the chop. We're still going to chop it up. So, let's look at the futures and see if we can discern any guidance here. So far, ES failing to fill the gap. And this actually starting to look a little cleaner. I kind of like this actually. So what we have cooking here. This first move down right there, that looks like an A. This looks like a B, potentially either that or that was the B in a running flat kind of thing with a lower high, which means that, and this is starting to look at the C wave action actually. So this is actually looking like the B, truncated A, B, C, truncated C there, 1, 2. Things could develop pretty quickly on the downside here. We're looking for a move down in here. If this is really the operative count, that looks like a 1, 2, 3, 4, 5. So we may see it push down in this 64.89 on the futures. Get a little bounce and another move down. And that next move down, the bounce, well, we'll probably push this on down here. The bounce would look something like this. We'd have to hold under that right there. We get above that 67.20, that kind of indicates the different path. And then this move down, reflected off of there. So it may be down around 6,400 even to find the bottom here. Now this will probably go quicker than this. We'd be looking for this to wrap up by next week. Yeah. More like that. Ooh. To move the whole bubble. There we go. More like that. That may be the path for the next couple days in Q. So we got a similar thing cooking, a little bit different though. since this has been a correction since October. And we're just chopping in here. This harder to discern. But we need the lower low to clean this up. NQ almost got it. Look at that. I mean, that's freaking close right there. We almost got it right there. That was close. NASDAQ cash index, on the other hand, though, this is what we really need to see is this lower low right here. This may push down. If we can get down in there, this can be this can wrap it up. And like I said, this may take through next week to get down there, though. May see more chaos and pops and bops, and it could even get away from us a little bit and come on down a little lower. So be careful out there, everybody. Count your save, maybe your own. See what happens. You have to add me some more levels down in here. Be safe, everybody. We'll see you again tomorrow. I'll be on Market Masters at 11:30. And have a great day. See you again soon.